14% APY on a stablecoin. That number sounds like bait. After Celsius, after Anchor Protocol, after every yield platform that imploded and took user funds with it, the instinct is to walk away from any number that high. That instinct is not wrong. But dismissing yield entirely because bad platforms existed is like avoiding all banks because one failed. The question is not whether the yield exists. The question is where it comes from and what you are actually risking to collect it. So let us break this down mechanically. The 14% figure being discussed here is not a fixed rate from a centralized lender promising returns out of thin air. It is a blended yield constructed from three distinct verifiable sources operating on decentralized infrastructure. Each layer can be audited, tracked, and exited independently. Layer 1 is base lending yield. Platforms like Aave and Compound continuously adjust supply rates based on utilization ratios. When borrowing demand is high, lenders earn more. When it is low, rates compress. Right now, USDC lending rates on established money markets are sitting in the 3 to 5% range depending on chain and utilization. This is the boring, foundational layer. It is real yield backed by over-collateralized borrowing positions. If a borrower defaults, liquidation bots handle it automatically before the position goes underwater. The protocol does not rely on trust. It relies on math and collateral ratios. Layer 2 is liquidity provision on concentrated liquidity dexes. Platforms built on Uniswap 5.3 architecture allow liquidity providers to concentrate capital within specific price ranges. For a stablecoin pair like USDC and USDT, the price rarely moves outside a razor-thin band. That means a liquidity provider can concentrate almost all their capital at the peg and capture a disproportionately large share of trading fees relative to the capital deployed. Fee APYs on high-volume stablecoin pairs on chains like Arbitrum and Optimism have been running between 6 and 10%, paid in the actual tokens being traded, not in a governance token with speculative value. This is not a reward emission. This is fee revenue from real trading volume. Layer 3 is protocol incentives, and this is where discipline matters. Some protocols still offer additional token rewards on top of base yield. The key distinction is whether those tokens have genuine utility and liquidity, or whether they are inflationary emissions designed to attract deposits at the expense of future token holders. Protocols like Velodrome on Optimism have a vote escrow model that ties incentives to governance participation, creating actual demand for the token rather than pure sell pressure. When these incentives are selected carefully, they can add 2 to 4% on top of an already real yield stack without the catastrophic downside risk of a Luna-style death spiral. Combined, these three layers produce a blended yield in the 12 to 16% range depending on market conditions, chain selection, and how actively positions are managed. Now for the risk accounting, because there is always risk. Smart contract risk is real. Every protocol mentioned here has been audited, but audits are not guarantees. Diversifying across 2 or 3 platforms rather than concentrating in one reduces single point of failure exposure. Impermanent loss on stablecoin pairs is minimal but not zero, particularly if one stablecoin in a pair depegs. USDC itself carries custodial risk tied to Circle and its reserve management. USDT carries its own counterparty opacity. These are known variables, not hidden ones. The fundamental difference between this yield stack and what Celsius was doing is transparency of mechanism. Celsius took deposits and made undisclosed loans to counterparties. Users had no visibility into where their money went or what collateral backed it. When those bets failed, there was no circuit breaker. The yield here is generated by visible on-chain activity that anyone with a blockchain explorer can verify in real time. The 14% is not a promise. It is an output. Market conditions change, utilization rates shift, incentive programs adjust. A position built this way requires monitoring. It is not a savings account. It is an active capital deployment strategy that happens to use stablecoins as its base asset. The takeaway is this: yield legitimacy is determined by mechanism transparency, not yield size. Double-digit returns on stablecoins collapsed trust across the industry because most people never asked where the yield came from. The ones who asked and could not get a clear answer should have walked away. The infrastructure that generates verifiable on-chain yield from lending markets, trading fees, and governed incentives did not collapse. It kept running. The lesson is not to avoid yield. The lesson is to demand a mechanism you can read.